Good morning or good afternoon, I guess it is for some of you. I don't know how many of you are all on the East Coast, but it's still morning time out here on the left coast. Good morning, Pat. How's everybody doing? You can all hear me, I'm assuming. You get the video started. Not that we need that, but all right. See if the crazy cat joins us. I just noticed, actually, we're getting ready to start. I was grabbing one more cup of coffee before we got going, and I noticed she knocked over her new water bowl. So there's water all over the floor. I'm like, ah! So I threw a towel down on it, soak up the water so it didn't get underneath the cupboards and wreck the wood. So I was like, hey, Rick, how you doing? Hello, Helen. Yeah, I forgot about that. Yeah, you're like, wait a minute, where's Rob? I'm not sure what he's got going, but I was asked to fill in, so I said yeah. So I love doing this. I have fun just coming in and playing around and teaching and bouncing ideas off each other, and so it's a good time. So it's weird. I got this. I don't remember where I saw it somewhere. She's already got a nice little filtering water bowl thing, and but this one was I'm gonna be gone next. I'm going to Montana next weekend, not this week, coming weekend, but the following weekend. So I'm gonna be gone for a few days. So I have this other one that it's one of those that drips water in it as it um um as she drinks it. So it'll last longer if need be, just in case the other one runs dry, which it probably wouldn't. But and my neighbor will come hang out with her anyway. He likes cats, but his wife won't let him get one. So he's like, I'll come over and hang out with her. It's like fine. So anyway, hey Brenda, how's it going, Kevin? Yeah, the market was exciting this morning, huh? It's still kind of exciting depending on what side you're on. But yeah, and I just realized that it was almost exactly a year ago that I filled in for this. So it was 8/13 of last year. So anyway, let's get the disclaimer out of the way and get rolling. I am not a registered broker, need investment advisor. I'm not going to give you recommendations or advice. Everything we do here is purely for educational purposes. So if I do happen to mention a trade, just assume it is a paper trade or practice trade. For regulatory reasons, we do not discuss funded trading. So here's all the events that are coming up. Inner Circle, the check-in is August 5th and August 12th at 7 Eastern Time. The monthly one is August 21st at 8. Mastermind Group, August 6th and 13th at 8 o'clock. Almost everything's at 8 o'clock Eastern Time. This one's kind of nice. It's early enough that because my office window faces west. So if it's an 8 a.m. Eastern, that's 5 o'clock here. This time of year, the sun's just beating in. So I have to close the blinds. But State of the Union trading, August 14th at 8. Trading You is the 15th, also at 8. Free online workshops, Power Hour. This one is every Monday at noon. Trading Coaches Playbook every Friday at noon. And the Spread Spectrum, I believe that's Brandon, August 5th and 7th. I think there's a slide on that coming up, actually. Power Option Place, Monday and Thursday. Cover Call Explorer with Trip on Thursday. And E-Mini Think Tank with Brandon Monday, Wednesday, and Thursday. So you can find us on all social media platforms, of course. Yeah, there it is with Brandon. Intermarket spreads. Spread spectrum. That's a mouthful. Especially when you got cat hair floating around getting in your mouth. Sorry. She sheds everywhere. So there's fur balls all over my office, all up and down the stairs, everywhere. So thank you, Andrew. Andrew just put a link in there for Brandon's class coming up. So this is what we're going to talk about today. When they asked me to fill in, and so you need to cover one pattern everybody needs to know. It's like, I'm not sure that I'm not familiar with patterns, but I'll try. uh, but it was funny because I was originally thinking, as those of you that know me know that my favorite is the Head and Shoulders, right? Um, and I think that's one that you need to know because if you go back to the last two market crashes, guess what preceded the market crash was the Head and Shoulders, right? Um, and in '09, I can't remember in 2000 or '01 when it bottomed out, but I know in 2009 there was an inverted Head and Shoulders that pointed out the bottom. So that's one reason that pattern itself is one of my favorites. But then all of a sudden it dawned on me just yesterday, actually, I was like, maybe I should cover something a little different. And then the question is it a pattern or is it just a concept? And in reality, it's both. I think a lot of us, it's easy to get stuck in that either or mindset versus the both and. It's not either a pattern or not a pattern, but it's both a pattern and a concept. So it doesn't have, it can be, that makes sense? So it's either a pattern or a concept, but in reality, it's both a pattern and a concept. So I figured, you know what? And especially considering the last couple of weeks, the traditional patterns, they haven't been showing up because of the volatility in the market and the craziness. And that happens from time to time. When the market gets wonky and it starts getting crazy, usually the traditional patterns start to get thinner. They don't disappear altogether. There are always patterns there. But this is an extremely prominent pattern concept that you will see pretty much on a daily basis everywhere. So I'm sure most of you have probably heard of it. You've probably seen it. So it might be a refresher for you. But some of you maybe aren't familiar with it. If you're not familiar with it, you need patterns in a flash. I'll just flat out say it. Role reversal, right? So in a lot of ways, it's a concept, but it is also a pattern. We'll go through this and then we'll go look at some charts. So if you have particular stocks you want me to take a peek at, keep those in mind. And in a few minutes, we'll ask you to throw those in the chat. So role reversal is really it's really not complicated. It's actually really simple on the surface, right? We're going to go a little deeper than that here because I don't like the superficial stuff. There's basically three different groups of traders, right? You got the longs who are bullish, people that want the stocks to go up, right? You got shorts that are bearish, like me, right? I've been bearish for quite some time, even though the market's been rallying the last year or so. I'm still bearish overall in the economy, and it's starting to play out as you can see right now. I think this is just the beginning of a larger, longer move down. That's my opinion. Just because of all the macro data, right? Then you've got the folks that are uncommitted, okay, that aren't in a position. They either don't have a position or they've already liquidated. They've already gotten out of a position, right? And we can look at this in the context from our own trading, our own experiences, right? Because sometimes I'm trading longs. I'm looking bullish, right? Just because I'm bearish in the big picture doesn't mean that I'm not trading bullish on a short-term basis, right? If there's something that looks bullish, I mean, in a way, we have the potential for a bull move over the next couple of days. You know, this huge gap down this morning, the Dow is in the process of forming a hammer pattern at this moment. I mean, I'm looking at the real-time chart right here on the screen. The NASDAQ tagged the gap just barely below the 200-day moving average, and it's rallied ever since. The SPX is neither. It gapped down and rallied for the most part, but it's not a big bounce. It didn't bounce off the 200 either. It hasn't quite gotten there yet. And the Russell is below that thing. The Russell gapped down, dropped off, tagged the 200-day almost exactly, and then rallied it. It's at an intraday high at this moment in time, right? We're only at, well, we're what, not quite 3 hours in the market, so we're not even halfway through the day yet. So things could change dramatically. It's been a wild morning. Hopefully, I don't know, Will's here. If you don't, you get trade watch alerts. I threw a little warning on there this morning. Said be careful buying options out of the gates, right? Because when volatility spikes like this, guess what they do to the premiums and options? They blow a whole bunch of air into that balloon. Fear factor is high, the VIX is high, the volatility is insane. They throw tons of extra time premium in it because that's what they can change. And then guess what happens when the volatility settles down? They just take it out. Or I didn't even look, Trip, because I knew that was going to happen. Trip said super wide spreads this morning, which is exactly what they do. That's why it's extremely risky. So the market, I think, is going to continue to stay volatile. We're going to continue to have these big moves. So you've got to be very, very careful when big volatile moves happen like this. When the volatility spikes, you've got to be careful if you're buying options. It is, in the right situation, it can be spectacular for selling options because then you're collecting those premiums, right? But, and I see Will's not here, but he's the first one that hits because he had a similar experience that I had years ago back in, well, it was the 2008 crash when Lehman Brothers went under. It was a similar day to today. The futures were down massive, and it gapped down. I remember looking at the spiders going, it was gapping like 10 points, something like that, which was huge back then. I don't remember what the index was at. I don't remember, but it was a massive, massive gap, just like today. And I was like, you know what? This is such a huge gap. It's probably going to bounce. But I understood volatility at that point. I was like, I got to be careful. Looked, and sure enough, massive spreads. And I was looking at the spiders. I thought I'm just going to buy calls on the spiders. Huge spreads. The options were selling for, I think they were in the money. I was looking at delta of like 80 or something like that because I knew that the time premium would be a problem. They were $15, I think, if I remember right. I don't remember exactly what it was. But in the first half hour of the market, I remember sitting there watching it. It gaps down big time. The options are 15. I'm like, that's crazy. The spread's huge. I'm not touching this thing. But I didn't sit and watch it. And about a half hour, 45 minutes later, maybe an hour, the market had bounced, kind of like it did today. It had rallied back up. And I go and look at the options, the calls, right? They were calls. It had moved up 5 or 7 or 8 points or something like that. So it should have been a huge win. $15, you would, with an 80 delta, I should have made $7 or $8 a contract. They were selling for $13, less than what I would have paid for them, because they put so much air in the balloon because of that fear factor. It just went, they sucked it right back out, repriced it back to normal once the volatility settled down. It was like, wow, it was crazy. And Will had that experience a couple of years ago with, it was a rental car company, not Enterprise. Maybe it wasn't Enterprise. It was the other one. Maybe it was Enterprise. I don't know. Same thing. The stock was at $180 one day. And it literally in 45 minutes, they came out with earnings in 45 minutes. It went from 180 to like 540 or something like that. And he happened to be watching it. I remember watching it too. I was like, this is nuts. This is absolute nuts. And up right near the resistance. I mean, he made it. Hurts. Thank you. He timed it about as perfectly as you could get in that situation. And he bought puts when it was up around 500. It hit like 550, I think. So he almost hit the peak. And in that situation with that kind of volatility, getting that close to the peak is impressive. It's pure luck, honestly. So not saying that, I mean, Will happen to hit it just at the right time. Almost perfect. The stock dropped $200 in the next like 2 hours, 3 hours, and he ended up losing money. He bought puts and the stock dropped 40%, and he still lost money on it for the same reason that thankfully I didn't get into it. And even though, and he says now, it financially is not fun when you do that, right? You expect to make money, and you should realistically make a killing in a move like that. But because the volatility was so high, they set the time premium out. Whoops. So it's a great experience, learning experience. So if you haven't learned that yet, then learn it from Will and me, because it's days like today. And again, I think we're going to have more of these coming up, that people get beat up with options trading, and it's because of the volatility factor. So you've got to keep that in mind. So anytime it gets crazy volatile, I always wait, let things settle down. And if you have a chance, I mean, go paper trade it just to see what happens. I wouldn't put any money at risk, but I said that on the Trade Watch alerts this morning. So be careful, because volatility is crazy. Options are going to be filled with premium, and you got high odds of losing, even if the stock moves the direction you think it's going, right? Now, if you are trading stock, that's different. If you would have bought a stock this morning, there's no time premium in that. So that's different. If you're buying stock, if you don't want to deal with the premium and worry about the premium of the option, then just buy the stock if you think it's going higher. Like a gap down this morning, buying something. I mean, like Apple, for example. I mean, I just happened to have the same thing with NVIDIA. Apple gap down to just under 200, hit 196, and then rallied. If you bought the stock, it's at 212 right now, you're up 14, 16 points. And NVIDIA gapped down to 92 and dropped off to 90.69 and then turned around and rallied. So if you bought the stock there, you don't have any premium to worry about, right? It's at 102 right now, so it's up almost 10 points. So what tool you use that best measures volatility? I mainly just watch the VIX. I mean, the VIX was up, pre-market was up like 48 points at one time, which was crazy. I don't know if I've ever seen it. I can't remember a time that I've seen it up that much pre-market. It's only up 9 right now. It's at 32. It was at, let's see. Here, you should be able to. Was that coming to the screen? I think it was. Oh, yeah, there we go. Okay, good. Just a little delay to it. So there's the VIX, right? This is the intraday chart. The top one is the 5-minute chart. The bottom one is the daily chart. But yeah, with the pre-market, turn this off during the day. I wish they had a toggle thing. It'd be so much easier to have to click 3 or 4 times. But yeah, I mean, there's the pre-market of the VIX, just went crazy. It was all the way up at 65 pre-market. So yeah, this is probably the simplest to gauge. I mean, from an overall market, the VIX is based off the SPX, so it gives you a pretty broad deal. I'm going to turn this off because I don't want to keep seeing the thing. Yeah, the VIX is one. I mean, there's other tools that are tied to specific stocks. I don't really use them. I just know that part of it is being at this for almost 25 years, and you just kind of know. So part of it's experience. The other part is you could use other tools. There are things tied to each specific option, but whenever volatility goes crazy, that's when I slow down and pull back a little bit. Like, okay, volatility's nuts. Just wait for things to calm down a little bit. So some of it's just a gut feel from based on experience, but the VIX is the easiest thing to use. And if it's doing what it's doing today, just chill out and wait a little bit is what I would suggest. But unless you like risk, lots of risk. So, and you know what? Sometimes it doesn't matter. Sometimes you can buy it because if the volatility continues to go higher, then they're going to continue to pump premium in it. So if you buy it when the volatility is low, but I'm an odds trader, I'm looking for high odds. When volatility spikes like that, that decreases my odds of coming out ahead big time. So the best situation is to buy when the volatility is low and sell when it's high. Easier said than done, right? So I got a little squirrel there about options, but I don't want you all get don't get hammered in this crazy market because it's insane. And it's a good time to be learning. If you're new to trading, this is a great time to be seeing it and experiencing it firsthand. Because over time, that experience will pay off, right? So don't sit back and like, oh, I'm missing this, I'm missing that, I'm not making any money. It doesn't. If you're gaining experience, that's valuable. So don't discount the fact that you're seeing something and experiencing something, and even if it costs you some money. I mean, like I said, Will's experience was extremely valuable because I can tell you, he's looking at things today and he's like, I'm gonna be a little relaxed with this one. I'm not gonna jump into anything when the volatility is that crazy. Now he knows, right? So getting back to the bulls, bearish, the uncommitted, right? Exactly, Brenda. That's a good point. Learning when not to trade is also trading. Yeah. Yeah. Sometimes the best trade is no trade. So good point. Yeah, there's another one. You guys I got them all this morning. Knowledge and patience makes more money than irrational exuberance. Exactly. And the irrational exuberance is some of us have seen it for a while. And it's coming to light now for some others right now as we speak. So getting back to role reversal. So what happens? Like I said, if you've traded before, you'll know, you'll understand some of these emotional things, right? Let's say you find a support, you buy something at support, right? And you buy the stock or you buy an option, whatever it is, you go long. You're happy, right? You're like, I should have bought more. That's always the thought, right? Especially when it moves in our favor. I should have bought 50 contracts instead of 10. But the shorts are on the wrong side, right? And those that are uncommitted are cranky because they missed it. I'm sure you've probably never been there, right? I'm there almost every day, and you have to just get used to it. As much as it's annoying and frustrating, especially when something moves big. It's the nature of the beast. It's just like a baseball player. I use baseball all the time, right? You stand there, watch the pitch go by, and like, that was the perfect home run pitch. But you didn't swing the bat. So it happens all the time in baseball. It happens all the time in trading. And again, as frustrating as it can be, you got to move on. So then what happens is the stock pulls back. And the longs are happy, like, woo, all right, I got another opportunity. And the shorts, if they held on, are now happy because it's back to break even, right? And the uncommitteds are like, all right, I got my opportunity. It pulled back to where I wanted to. Now I'm going to get in. So they buy, right? And then what happens? You all know, right? Murphy shows up. Like, oh, right when I bought in. They know I'm buying. Nobody knows. Nobody cares. Not just individual traders like us. They're not watching you, I promise. But what happens is those that got long, whether it was the first bounce or on the attempted second bounce, once it breaks that support, now they're like, oh, what do I do now? Right? Some of them are going to have stops in. Some people will. The smarter traders will, for the most part. Some will just sell. They're like, okay, I was wrong. I'm out. Some will get margin calls, right? If they were heavily margined out and they have to bring money in, or they have to, if they can't bring money in, they have to sell, right? They get a margin call, they're going to sell the stock. That all creates selling pressure. Now, those that went short, they're happy. They may even want to add to the position. They're in the opposite place the longs were, kicking themselves like, oh, I wish I had more. I wish I had shorted more. So they're looking to add to the position, right? They want more. They want to add to the position because now it's broken support, what they expected it to do, right? That's what they thought would happen. And the uncommitted traders, those that were short uncommitted, that wanted to get short, that were waiting for the breakout of the support, they now enter the trade. They may have a hook down that says, if it breaks this level, then short the stock. So longs start to sell. There may be some margin call. It creates selling pressure. The shorts are happy. They might be adding to their position. And the breakout traders, the ones that weren't in a position, are adding position. So that creates selling pressure that sets the stock lower. And then it bounces back up, right? Some of the shorts, maybe the really short-term shorts, have covered their positions. Maybe somebody's just buying it as it drops. Who knows? There's all kinds of reasons people buy. But a lot of times, and again, these aren't hard and fast rules. It's conceptual. This is what happens quite often. So it bounces at the next level of support, bounces back up, gets to the previous support, and the longs that bought in at that first support, their mindset is what? Some of y'all maybe have been there where you bought a stock or you bought an option, you went bullish on something, and it broke support. You didn't have a stop. You didn't get out. And where did your mind go? I just want to break even. I don't want to lose. I don't want to be a loser. Nobody wants to be a loser. So I can't lose on this thing. So if you can just give me my money back, I'll be happy. Am I flying solo here? Am I the only one that thinks that? I still think that sometimes. I mean, most of the time I have stops, but in reality, sometimes I either don't or it slips by me and I'm like, oh, now what? You're upside down. And it's like, just give me back to break even. And there's not anything wrong with that, but that's the natural progression that our mind takes. Is we don't like to lose, so we want to get to break even. So you have the longs that got long at the support, and now it's bounced back up. Now they're back where they can get break even. So what do? They sell, which obviously creates selling pressure. Then you have three bearish players. The longer term bearish players, those that are maybe looking for a bear trend, maybe they took a small position to start. Maybe they trade like me. Maybe they scaled in and picked up just a little bit on the break of support. And then if it rallies back up to the previous support and gives us a roll reversal, then they add to the position, which is what I do fairly common. Then there's the breakout traders, right? That they may have sold short or gone bearish on the break of the support. They may have closed it at the next support, and now they're looking to re-enter because they understand the concept of roll reversal. And those that were waiting for a roll reversal, the conservative traders, they start to enter. So you've got three different bearish players coming into it, and you have the longs that start to sell because they just wanted to get back to break even. Yeah. There's those famous last words. Just get me back and I'll never do it again. Just get me back to break even. I just don't want to be a loser, and I'll never, ever lose again. You got to be honest with yourself, right? We all do. You're going to do it again. So that is essentially the concept of role reversal is it is literally a mental, it's emotional state that people want to get break even. It works either up or down, whether we're talking about a downtrend or we're talking about an uptrend. Because you have people that are short in it. I think it's at least it seems like it to me. I've never pulled the data on or looked and done any actual studies, but it seems to be more common in the uptrends and downtrends. But don't quote me on that. Like I said, I've never done a study on it. It doesn't really matter. But the reality is that when you learn to recognize it, you see it. Now you can take advantage of it, right? And in a volatile market like this, there's quite a bit of that happens. So, and one thing, if any of you have been through patterns of flash, you know that most of the patterns also do role reversals, right? You get a head and shoulders, it breaks the neckline. It's not uncommon for it to bounce back up, tap the neckline, then roll over. That's your second entry point. Depending on how you trade, right? I'm very aggressive, but I'm also very conservative, right? I will pull the trigger on a trade at an aggressive entry point, but I'll just do a really small position, 1, 2, 3 contracts. Because we've all been in that position where you don't get into something and you miss it. And you're like, I should have gotten in because it takes off without you, right? And then you get into something. There's the other situation where you get into something and it backs up against you. And you're like, I should have stayed out. But we never know, right? It's a 50-50. It's a coin flip. We don't know what's going to happen next. We don't have a crystal ball. And so one of the things that I figured out, I don't know, 10, 15 years ago was scaling. And scaling out was what most people learn in the beginning. That's what I did, right? So I started scaling out of my trade. Then I'm like, why not scale in? Because you have that fear factor going, well, I don't want to miss it if it moves big, but I also don't want to take a lot of risk because I'm not really that confident in the move. So why not just pick up 1 or 2 contracts, maybe 3, just a small position, whatever, size you're playing with. Just take a little position in the aggressive entry place. And then if it moves and it moves big, I mean, how many of you wish you had just 1 or 2 contracts on something from Friday, like an Apple or an Nvidia, right? Because it just gapped huge this morning. You would have had huge profit, but you weren't there, right? So by taking a small position at an aggressive entry point, at least I'm there in case it moves in an unexpected way that now I can profit from it, right? So it's managing the fear. Now I'm not afraid of missing out, but I don't have a lot of risk on the table. So if it backs up against me and I get stopped out, then that's okay. It doesn't cost me a lot. It might only be 100, 200, $300, depending on what size you're working with, right? So something to think about. But that's one of my favorite ways to do it is take a little position on the breakout. If it rallies back up, it doesn't hit my stop, and it rolls over at the previous support, hits a new resistance, then I'll add to it. I'll put a little hook below that, add to it, go to maybe a full-size position. Depends on what it looks like, right? Always analyzing the chart and seeing what it's doing in real time and going, okay, here's how much risk I want to put on the table, depending on how good it looks. So the size of my position is always based off what the chart looks like. Sometimes it's 1 or 2 contracts, sometimes 10 or 20, 30, just depends, right? So here's some just generic examples, and then we'll go to, if you got specific charts you want to look at, start throwing them in the chat. And you can look at charts all day long and you'll see this, right? Old support becomes new resistance. And again, does it happen 100% of the time? No, it doesn't. But it's more often than not, right? Old support becomes new resistance. You can see how often that happens. I mean, I don't know how much time frame that is, but we'll look at some actual charts. Oh, where'd that go? I thought I had another slide here, but excuse me. There was one. Did it go? Nope. It got disappeared somehow. Whoops. Not what I wanted. What is going on here? Hit the wrong button. Well, the other slide said, it was just a couple of points, was it is typically more common in trends. When things are trending, either bullish or bearish, you're going to see role reversals more often, right? If something's, channeling or going sideways, you're not going to see it that much. They're generally speaking more frequent in trends. Excuse me. But let's go. Where did my trade nav? It's not what I wanted. There it is. Only up 11 grand today. It was up 25 grand this morning. Almost all short positions. So I took profit on some. I scaled out of some of them, like banked some profit on some of these, but they're bouncing back, and I'm not surprised. Do I think this bounce is going to hold? Probably not. I think it's a 1, maybe 2 day thing. We'll see. I mean, it's not a huge surprise that when you have a market like it's been, the bulls are looking for a pullback, and they're looking at this going, we're down 10, 12%. It's time to buy. It's discounted. And they may be right. Maybe we'll take off to the upside from here. But I think we've transitioned from that place that we've been in the last 8 to 12 months where bad news was good news. And now bad news is bad news. Right? I mean, bad news is always bad news, but the question is, how does the market perceive it? The last 8 to 12 months, the market has been perceiving bad economic data as a good thing because that's going to get Jay Powell to cut rates. That's all the market's cared about for the last 8 to 12 months. Just cut rates, cut rates, cut rates, cut rate. We want rate cuts. And so everything that indicated that a rate cut was going to be coming, they got excited about, went bullish. Like, all right. Well, now, no rate cut last week. And the data is not that spectacular. And then unemployment data came out. And then Intel came out and said, yeah, we're doing terrible. We're getting killed. And we're going to lay off 15,000 people, which is huge. Right? Even for a company like Intel, I don't know how many employees they have. I'm guessing around 100,000. But a lot of layoffs being announced. Unemployment, I won't be surprised to see unemployment hit 4.5, 4.6 next month. Because there's a lot. I know people that are getting laid off. People in tech companies. Because the revenue's not there. The economy is slowing down. I mean, I've met a lot of people that are in other industries. There's a lot of reasons people are getting second and third jobs. The unemployment picture is getting worse, and it's going to continue to get worse because the feds are slowing down hiring because they can't. That's where a lot of the employment has come from, is the federal government is hiring people, which has to be paid by the taxpayers, right? So, which makes the budget deficit even bigger, which means we're going deeper into debt. So people are starting to realize that some of the stuff we've been seeing for months under the surface, people have started to see that there's possibly a big tsunami coming to shore because some of the signs are starting to show up. So, but I've been talking about it for several months now that things are getting sketchy. Well, the market's starting to figure it out, I guess I should say. Okay, there's today. Yeah, now some are saying he waited too long to cut. Everybody's a money quarterback. He waited too late to start raising rates, which I think is true. I don't think still don't think he can cut realistically because inflation's not good. If he cuts, guess what happened? Inflation's going to kick back in. It's going to start ticking back up. Maybe. I mean, it may not. Oil's down. Well, I guess it's flat now. It was down a bunch this morning. Yeah, the Fed's late to the party, almost always. If you haven't read the book, The Creature at Jekyll Island, I think it's called, go get it. It's on Audible too. I listen on Audible. It's like 24 hours long. It's a big book. But if you like history, especially if you like history of the markets, then it is a very, very good book. So it says it will open your eyes to some things. And realistically, when you go back historically, central banks have pretty much always failed in the end. They never, ever, 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 ever get it right. They occasionally do short term, but in the long term, central banks always mess things up. They make economies worse. So as far as I'm concerned, we should go back to the gold standard, have sound money. But that would be it's not impossible. It would be very difficult to do. There'd be some significant pains for a lot of people, but a lot of countries are starting to do that. There's part of the reason the gold has gone up as much as it has is because a lot of countries, a lot of central banks, a lot of foreign governments are buying up gold. So, yeah, Jackson was correct. Central banking is it's a top down. Government officials that are supposed to be smart and they're not seeing reality. So I know I'm looking at this. There's not much to look at here, Brando, with the spiders. I mean, it's the SPX, right? Exactly, Karen. Well, that's depending on how far down the conspiracy train you want to go. It's for governments, it's always about controlling the people most of the time. It'd be nice if we could get away from that, um, and elect politicians that aren't necessarily interested in just power. That's not what I want to do. So, all right. So we're looking at role reversal now. Yeah, exactly. Good luck with it. It's called human nature, right? Once you give somebody power, they want more power, generally speaking. I mean, look at how powerful I am. I'm sitting here. No, I'm just kidding. Got y'all brainwashed. So we're looking at role reversals. I went back in a mode of just analyzing the chart like I usually do. I'm like, okay, where's the trade at? So when you start to put support, I'm looking for, and again, this is not, role reversals is not every time. I'll get rid of that, actually. I'm just going to start doing this. Well, you can see there. Well, there's a little kind of, yeah, this is back last year. Well, this is where the Fed came out and said they were cutting, right? So there was a head and shoulders right here. My favorite pattern. I remember this. This is when all four major markets were doing the exact same thing. The SPX, the Dow, all were in a head and shoulders pattern, and the Russell, which happened in 2008. Right, all four of them showed a head and shoulders pattern in 2008, just before it crashed. So head and shoulders, that's why it's my favorite pattern, because it does show some spectacular things in the market. It shows that the bulls are getting weak, and that's what we had here. Of course, it breaks down. It actually, the head and shoulders actually played out. But then this is where Powell came out and said, we're going to cut next year, start cutting next year because inflation's headed the right way. Well, this is irrational exuberance right here. This is the market getting excited, going from 400 to 550. Like, what? But you can see when it broke down here, when we broke this previous low, it broke right here, and then it came back up, tapped it, and rolled back over. Right? And you've got, oh, that's not the one. I don't know if this one is, but again, it doesn't happen all the time, but I don't know if intraday that's, no. Well, there's one right there, right? We got the previous high here. It breaks out of it, pulls back, taps it, rallies. So nothing's 100%. But when things are moving, I mean, you could take some of these really micro ones too and go, well, there's a little one there, maybe a little one here. I usually look just at the big ones, but let's look at NVIDIA. I don't want to look at just the markets. Actually, I'm going to, yeah, get rid of all that stuff. That's fine. Start over on it. Well, there's a beautiful one right there. Y'all see it? Double top, and it's a beautiful double top, realistically. And you got the midpoint right here. It comes and taps it a couple times and breaks below it. And where does it come back up to? Comes up, taps it, and rolls over. So you can get a lot of swing trades in if you just understand this one simple concept of role reversal. Okay, well, there's not only do we have that in play, but we've got the double top, which says that the break of this actually would have created a trading candidate, right? We got the double top, bearish engulfing pattern, bearish engulfing pattern. So lots of bearishness going on right here, saying that things are probably going to head lower at some point. The question becomes when. Well, with the double top, we're waiting for the break of the midpoint, which is right here. And we tested it here, which actually is beautiful. That's perfect because now it validates this line. And then when it breaks it, that's even bigger deal, right? So I did catch some of this move. I got out of some of it this day, right? So I had 4 or 5 day trade, got out of a portion of it, got stopped out the next morning, which was irritating because it was, we went from a really nice, healthy profit to very little profit. Nice, healthy profit on like 15% of the trade because I scaled out of it at 105 and 106. I took a piece of it out, 10 or 15% of it. Of course, I should have reloaded it here, but woulda, shoulda, coulda, right? So it did a beautiful roll reversal and then just tanked. So other ones, there's one right there on the bullish side, even though it's not, it didn't come all the way back down to it, but it got close, right? And sometimes that's going to happen. What else? GLD, isn't that the gold index, gold ETF? Yeah. Which Yeah, gold's bounced back. It was down to 50 or something earlier today, but you see in the sideways moves like this, there's not a whole lot. It's basically going sideways here. You got some of these things, but it's not really in a spectacular trend. So there's not a whole lot of them going on. But if we get in a nice solid trend, I'm trying to think of something that is nice and trending. The Qs are kind of, this is going to look almost identical to the spiders, but you're going to have there's some roll reversals there. There's the old previous high comes down there, but there's one recently too, right? Which is no surprise. I mean, the Qs and NVIDIA makes up what percentage of the Qs? It's some enormous number. That's the biggest, I think, is Apple and NVIDIA make up like 10% or something like that. It's a huge number, but so it should be no surprise that you're getting the same type of look from the Qs as you do from NVIDIA. But you can see, again, I mean, drops down, breaks that support. We've got that recent support there and comes up and taps it and then sells off. So could we, I won't go there. I can speculate. All right, I'm trying to think of what's a stock that's been in a long uptrend or a downtrend, either way. Let's see what we have. Apple, not really. Even though CMG, yeah, except for the last month or so. They're getting destroyed now. What did I just saw something here, but well, let's look at CMG. Yeah, that huge split was yeah, but there's a nice move there. And in big moves like this, you don't see it quite as often. When we're in a nice, normal, steady trending market. So maybe this wasn't the greatest topic with what's going on right now, but because of how crazy it's been. Well, and there's one essentially right there, right? You got the previous highs here, it breaks out, goes sideways for a few months when it does come down, but usually roll reversals are happening more short term, like that right there, right? We hit a peak, we rolled back, we pulled back down a little bit, rallied up. Let me zoom in there, right? Rallied back up, then tapped it and took off from there. I'm not seeing any other big ones, but and some stocks do it more than others, so it just depends. Is it better on a day chart? It will work on a 5-minute chart. It'll work on any chart. That's one of the beauties of technical analysis. It's one thing I've always said is that it's the beauty is once you understand the concepts, the patterns, you can apply them to any time frame. Whether you're looking at daily, weekly, monthly, hourly, 5-minute charts, 1-minute chart, tick chart, the concepts all apply. Now, if you're looking at a tick chart, yeah, you have to adjust for time frame. Tick charts are a little bit different animal, but for the most part, it's still there. The vast majority of the concepts, 99% of the concepts are still there. They still apply. Patterns, double tops, double bottoms. It's just a tick chart it can be a lot faster. If you're not familiar with the tick chart, a tick chart is literally every single tick. Every single trade that goes off in the stock gets noted on the chart. So it's mostly used for day traders, futures trading, very short-term trading. So, but again, 99% of all charting will apply no matter what time frame you're talking about. So that's the beauty of it. Once you understand the concepts and how to read charts, how to analyze them, and how to break things down, then you could transfer that to any time frame, any instrument. It doesn't matter if you're trading stocks, options, futures, forex, Bitcoin. If you're trading that stuff, the concepts all apply. Because the reality is this: when you really peel the onion back and you go deeper into why markets move the way they do, it's all because of human emotion. Whenever I hear somebody say, "Oh, markets move based on news," no, they don't. That's the shallow, superficial definition, but it moves based on people's emotional reaction to the news. Because take it the last year. I mean, when inflation data came out, it wasn't good. It was a little bit better. It improved, but it still really wasn't very good. Even when inflation ticked up 4 or 5 months ago, the market saw it as good news. You have the bad news is good news thing. They look at it and go, oh yeah, well, good. That means that the Feds are going to cut. That doesn't make any sense. Not on the surface, it doesn't. It doesn't make sense that McDonald's came out and said we missed earnings. We missed our top line and our bottom line. But then they went up big. They were up 4% the day after earnings. Like, how does that make any sense? And then other companies, they beat earnings and they get tanked. Superficially, it makes no sense. But when you peel the onion back, you go, okay, well, yeah, they beat earnings, but the market doesn't care what you did last quarter. Market cares what you can do for me next. So I didn't hear McDonald's earnings calls, but they must have said that things were looking up for them. That's the only thing that makes any sense. Because there's no other reason for them to go up if they missed earnings, unless they're saying the future's getting better, which is why companies that beat earnings and they go down, that's usually what they do. They come out and say, well, we beat earnings this quarter, but next quarter is going to be terrible. So it's the whole figuring out the news thing is kind of goofy, but yeah, it's still always the same. No matter what time frame, no matter what instrument you're trading, the core technical analysis, because this is what you're seeing right now in front of you. This is the visual representation of how traders are feeling about this particular stock. Traders right now don't feel very good about Amazon. They didn't feel very good right here either this day, 3 days ago. That's what the bearish engulfing says. It says, well, the bulls were excited in the morning when we opened it. In fact, they ran away up here to about 190, and then the bears came in and smacked them down. The bulls were ahead in the first quarter, but by the time the buzzer rang at the end of the day, the bears had taken over and smoked them. They were up by 10 and they lost by 30. However you want to analyze it and put it in your head and make it make sense, I use all kinds of things like that to be like, okay, this is just how it works. Oh, I haven't looked at crowd. But this is the visual representation of what people are feeling about particular stocks or indexes, markets, whatever you want to attach it to. So, well, since we're kind of sort of looking for role reversals, there's actually some decent ones back here when we're trending. All right, that one's not perfect, but it's close, right? You got one here, it breaks out, pulls back, taps it. I don't know if that, not quite, but there's another one that was, excuse me. You can see, so when we got a nice move like this, when it's in a nice solid trend, they show up quite often. Role reversals can be good for adding to positions. Let's say you bought into Amazon back here at 100, right? And you got into it here and it breaks out, comes back. You're like, okay. And then it breaks out here. And you're like, oh, I missed it. Well, wait for it to come back. And if this is, 109.82 is the peak, maybe you add to your position here. If you're in a long-term bullish position on Amazon, so that's something you can use it for, is adding to positions. If you're already bullish and you want to add more to it, as long as it's trending, keep adding to it. If it breaks out, pulls back, add to it at that spot. Or you have a hook on the breakout, whatever works for you, right? Excuse me. So yeah. Yeah, what is CrowdStrike doing? It's still down there. Oh my goodness. I know. Well, this is a trade we looked at in the weekly whispers and actually got into. I don't remember which day. I think it was this day. Trading plan might have originally been different, but yeah, it was absolutely short the stock. And then this thing hit, the news thing hit. And it's like, whoo, this is one of those just dumb luck, and that's trading is a combination of skill and luck. The skill comes in learning to read the charts, learning to understand the big picture, learning to read the charts, analyze the charts, come up with some idea of what you think might happen next, and then get in the way and hope that it works out. And once in a while, it works out spectacularly well, right? Just like a baseball player, when he walks up to the plate, he doesn't know if he's going to hit a grand slam or not. He might look at the situation and go, well, what's the, bottom of the ninth, 2 outs, counts full, bases are loaded, we're down by 3. If I hit a home run, I'm going to be a legend. And how often does that happen? Not very often, right? There's 1, maybe 2 times that's happened, right? But you analyze the situation, and based on that, you decide what to do, and then you swing the bat. And sometimes you swing the bat, and it just hits perfectly, and you get a grand slam, right? They're rare, but they do happen. And trading's no different. You got to get in and swing the bat, right? And that's really all it is you're looking for the right pitch. So, yeah, CrowdStrike worked out beautifully, except I got out at, I think it was 294, 295. I took some out. Then it gaps down the next day, and I was like, I think this is probably going to keep going. So I left it alone, and it got down to I think it was one of these days here where it started to bounce to 260 or 250. Maybe it was just no, it was just 240 where I took the last little bit out. I think I originally had 300 shares and shorted it, and because that's all you can do in this practice platform. But same as 3 option contracts. But yeah, it came down and hit this 243 one day. I'm like, you know what? It started to bounce intraday, only up to here, and I'm like, I don't think it's going to keep going. I'm just going to take it. I mean, I've only made like 120 bucks of profit on that one, and made like 60 or 70. So it was a massive, massive profit, massive win, and it was just dumb luck. Just like the guy stepped up to the bat and swings. It just so happens that at the right time gets a perfect hit. It's just luck. So, and that's but you can't get lucky if you don't get in the way. If you don't swing the bat, if you don't even get out of the dugout, right, you can't hit a home run. So you got to get out of the dugout. You got to look at the situation. What game is it? What inning is it? What are the outs? Who's pitching? Right? They go and analyze the pitchers. Right? They go see what kind of pitches they throw, figure out all that stuff. So when they get to the plate, they have better odds of getting a hit. So PE's 407 at the level it's at, or it was up there at 400. That's crazy. Even though I'm not a fundamental guy, but I know the average PE, I think, on the SPX is, well, I think when it's high, it's like 18 or 19, isn't it? I think the average is about 15. And is it 407? Yeah, that's irrational exuberance. That's like 2000 type of levels. Some of these companies' PEs were like 1200 or 1500. And it's like, really? It's just wild and crazy. So, but let's see if there's anything else here. Wow, that's crazy. Yeah, earnings is 54 cents and it's at 220. So yeah, today's PE is about 407. That's nuts. I mean, I can see, some companies, especially when they're newer, younger tech companies that have a lot of growth potential, a higher PE can be justified. I'm not saying it has to go down to 15 to be reasonable. I don't know what a reasonable PE would be for CrowdStrike because like I said, I'm not a fundamental guy, but yeah, that's still crazy though. Even though I don't know much about fundamentals, I know that's insane. Looking for something there as well. We look at the Amazon already, Bank of New York. There's kind of one, but see some of this, and there's the other thing. You don't get a lot when you get a crazy run like this that's all based on emotion. You're not going to get a ton of role reversals, or if they are, they're quick little ones like this. There we go. You got just a little tiny blurt, but then whoop, and then you get another one kind of right here where we peak out, then rally back down. So you do get them, but they're just not as when it's in a big run like this. Which this is all that excitement about the rate cuts coming. But there's also one here. We kind of slowed down a little bit, and then when we finally broke out, it came down and tapped us 3 times before it took off big time. But that's Bank of New York Mellon. So, and the banks, especially the little banks, this is one of the reasons the Russell's getting hammered, which I suspected the breakout we had 3 or 4 weeks ago was a false breakout, just like we had in 21 that preceded the bear market in 22. So, and if you're in any of if you're in Weekly Whispers, then because I've been talking about it for weeks about the divergences between all the major markets. Today, they're behaving normally, right? The SPX is off 2.7%, the NASDAQ's down 3%, the Dow's down 2.3%, the Russell's down 3% as we speak, right? That's normal behavior. But when you have the Dow and the Russell up 1 or 2% in the day and the SPX and the NASDAQ down 1 or 2%, that's not normal. And over the last couple months, that's what's been happening. You're getting one market going this way. The Russell's been up while the other markets are down. And then the SPX and the Dow or the SPX and the NASDAQ are up and the Dow is down. It's just been wonky. And that's exactly what was happening at the end of 21. And I was calling for a bear market then, saying this is not normal. This is an indication that things are getting worse. And that's what it's been doing the last month or two in the overall market. I think today, the last couple of days have been an indication that this big run is now over. The question becomes, how far does it fall? How long does it take? Is it going to be a full-fledged all-out crash where it just blitzes to the downside? Or is there going to be a bigger tug of war between the bulls and the bears and it's going to take a little slower. It's going to be a little slower downtrend. I mean, that's essentially what we had in 22, right? If we go back and look, right? So there's the bear market essentially right of 22, which again, this is another reason that I love Head and Shoulders. There's a Head and Shoulders right there that it didn't quite work out textbook wise, but it did give us an idea that things are getting bearish. But yeah, there's basically January until we bottomed out about a year later. This was kind of just a mundane, slow bear market, right? We got a sell off and then it bounces back a big time. And then we pretty big sell off for a month or two and a decent bounce back. There's a beautiful roll reversal right there, actually, which you'll see. When you get the big swings like that, that's something that will happen quite often. There's another one, right? You got the bottom here, it breaks that, comes up and taps it, and then rolls back over. So when we're trending, as we were here for a short time at least, then you'll see those more often. But let's see if we can put that on here. Or RUT. See, and here is, so that purple line is a Russell. And you see how crazy it went. That's after right, here's the COVID crash on the left-hand side. And both markets were in tandem, right? And then the Russell took off big time and was on a steep ascent back here. The SPX just kept going solid. But what you'll notice is, if I move these lines over here, that the Russell slowed down right here. Between those two lines, you can see the Russell pretty much was just going sideways, and the SPX continued to run. I talk about this quite a bit, but the Russell, if you're not familiar with it, is the small caps. It's the little guys. And if there's a storm brewing and you're out in the ocean, the aircraft carrier is probably going to withstand the storm just fine. The little fishing boat, little 20-foot fishing boat, they're hightailing to shore. Because if there's a big storm coming, we're going to capsize, and I don't want to die today, right? So the Russell is the small cap companies, and they have to adjust and shift a lot quicker. And the higher interest rates affect them a lot differently, right? Because they don't have deep pockets like the Microsofts of the world and the Apples, and they have billions of dollars in the bank, right? They're the big aircraft carriers, and they can withstand the storm. In fact, they can prosper and do well in the storm, typically, right? They'll go use their cash to buy up these smaller companies that are struggling. But the Russell represents the little guys. And I had a valuable lesson when I started in 2000, right at the peak of the crash, when the crash started. Literally, the NASDAQ dropped 650 points the first day I sat in a workshop. And it was like, it was a day like today. And of course, I had no idea. And all my coaches at the time had no idea that a crash was coming because they'd only known a bull market. All they'd ever experienced was buy low, sell high, buy the dip, buy the dip, buy the dip. That's all they did. And they kept buying the dip, kept buying the dip, kept buying the dip. And that's what I learned, buy the dip, buy the dip. And that's what I did. I had 6 months, I scrounged up some cash, threw $1,000 in an account. And 2 months later, both the trades I did were expired worthless. It's like, that was no fun. I better figure out what I'm doing. I thought I did, but I was buying the dip because people hadn't experienced a crash. But in 2001, you listen to all the talking heads in the media, but you kept hearing people say, well, it's the little business, the small businesses, which make up about 85% of business in the US, right? It's the little guys, it's the small businesses that bring us out of a recession, which is true, right? They employ 85% of the workforce. But if they bring us out of a recession, the inverse of that is true then too, is it not? So if the little guys are not doing well, they will take us into recession. They have to adapt and adjust quicker. They will lay off people faster. They'll stop spending. They'll stop buying excess stuff. They'll stop doing, because they have to. They have to adapt because they don't have deep pockets. So looking back here at 21, and you can see that just sideways moving the Russell, which is an indication that those little guys are not doing that well. They were killing it here. And a lot of the little regional banks are in the Russell. So when you see when SVB got hammered last year, when it went under, the other ones too, the Russell got hit hard. That's right here, actually. If I remember right, yeah, it was March that year. The Russell got hammered right there because that's where a lot of the small banks live, is in the Russell. But you can see the sideways move, and then we have this false breakout. And look at what we're doing today. See, a few weeks ago, I was like, when it busted up like this, I'm like, that looks a lot like this. We get kind of a sideways move for just a few months here. It's almost a year, but Here we get just a sideways, and the Russell's really been just going sideways. You can see here for, I mean, since 22, even though the SPX has outpaced it. And this break to the upside was kind of this rotation. People were getting out of tech and going into the small guys. So the SPX and the NASDAQ were selling off, and the Russell and the Dow were going boom, taking off to the upside, which again is not normal, right? So we have a very similar picture today that we had in 21. So, and you can see what happened over the next year is that we sold off and we went into a bear market. So the fact that we're yeah, isn't, oh, that's because these are the indexes. The indexes don't update intraday. I don't know why. It has something to do with the data provider, I think so. But it's the fact that we're on and today doesn't necessarily matter for what we're looking at here. So, are we headed for this again? That's what it looks like to me. We're in we have a very similar picture that we had at the end of 21, and during this time at the end of 21, the market was behaving a lot like it is now, where you have the markets just diverging from each other. And I remember talking about it back then, going, this is just weird. It's not normal. They're all usually in tandem like they are today. Today is a normal day. All four, the SPX, the NASDAQ, the Dow, and the Russell are all performing about the same. But when they're wonky, that's a big red flag, is basically what it is. So just be cautious. I know some people are like, you're so bearish. Like, be optimistic. It's like, I am optimistic because you know what? I can't do anything about that economy out there. I have no control whatsoever on the larger economy. The only economy I can control is mine. And if the market's going to tank, then I want to take advantage of it, and I want to improve my economy because I know how, right? As traders, we know how to take advantage of the downside. And people are like, I don't want people to suffer financially, but I don't have any control over that. So I'm going to do my thing. I'm going to stay focused on my economy and look to improve my economy, even if the rest of the economy is getting hammered. Right? Yeah, I'm optimistic that my puts will make money. Yeah. Today's a beautiful day for me. That's why I'm in such a good mood. I'm usually in a good mood. And even if, but if things were going the opposite direction that they are today, I'd still be in a good mood. I'd just be a little bit not quite as in a good mood, right? So, because I've been bearish for quite a while, and I have quite a few puts loaded up. So when I woke up this morning, I'm like, woo, today's going to be a happy day. So, but tomorrow could be the opposite. That's the thing we don't know. We might get some kind of news that comes out tomorrow that all of a sudden things go crazy to the upside, and then I'm not happy, right? But trading is it's a roller coaster ride, right? It's always like that. So it's a mental game more than anything. So, but that's one of the benefits to trading short term is not only do we know how to take advantage of the downside, but you can also stay out of the way if things are crashing. If you're long, if you own stocks, right? You can buy puts as insurance. You can sell calls. You could realistically, depending on what the situation is, sell in the money calls and collect even more. There's a million different ways to structure your business depending on what you're looking to do and what you want to do. So yeah, learn how to ride the dragon. Exactly. I don't know where your cat's at, Brenda. She's not up there? I don't remember seeing her come in. I don't know. I don't know where she went, but hopefully she's out cleaning up her water mess she made. She doesn't have the opposable thumbs, though. All right, I'm over, so I'm going to shut up now and move on. So any quick questions before we call it a day? Is there anything I missed that I didn't see? I don't think I missed anything, but. Yes, happy trading. Today is happy trading. For now, like I said, it could all change. There's one of those things that you might be happy this moment, and in 3 hours, you might not be so happy. I've been through all of it. So anyway, all right. Well, appreciate you coming, hanging out, and let me fill in for Rob. It's always fun to come and chat with you guys. So have a wonderful week, and we'll see you. We'll see you on the next go round. All right. Bye for now.